It should give you cause for some concern and some caution.
Learn from the wisdom of Jeremy Grantham as he dissects the cyclical nature of market bubbles. His insights can help you navigate the complexities of investing and make more informed decisions about your own financial future. Before we dive in, if you've ever thought about investing, the first link in the description takes you to Interactive Brokers, the platform I use. Financial bubbles are phenomena where asset prices rise far beyond their intrinsic value. This occurs due to excessive enthusiasm and speculation. Investors often believe that prices will continue to rise. This belief creates a self-fulfilling prophecy. As more people buy into the hype, prices inflate even further. Eventually, reality sets in and prices collapse. The cycle of euphoria followed by despair is a hallmark of financial bubbles. Bubbles are often characterized by a disconnect between asset prices and underlying fundamentals. During these periods, rationality takes a back seat. Investors become driven by emotions. Greed and fear dictate their decisions. This irrational behavior fuels the bubble's growth. When the bubble bursts, it leads to significant financial losses and economic downturns. Market euphoria, a recurring pattern. History is littered with examples of market euphoria, periods of excessive optimism that inevitably lead to crashes. The 1929 crash and the dot-com bubble are stark reminders of this pattern. Investors blinded by excitement often ignore fundamental valuations, leading to unsustainable price increases. The recent 2021 bubble, fueled by AI hype, followed this familiar script. Understanding these historical precedents is crucial for navigating the unpredictable nature of financial markets and avoiding the pitfalls of excessive optimism. The role of AI in market dynamics. Artificial intelligence has transformed market dynamics significantly. It has become a driving force behind innovation and investment. Companies that harness AI capabilities have seen substantial growth. This has led to a surge in stock prices for these firms. However, the excitement surrounding AI can also lead to overvaluation. Investors may overlook fundamental assessments. This creates a precarious situation where prices are not supported by performance. The long-term implications of AI on the market are still unfolding. It poses both opportunities and risks for investors. The impact of stimulus on economic cycles. Government stimulus plays a critical role in shaping economic cycles. The massive financial stimulus during the pandemic altered market dynamics. It injected liquidity into the economy. This led to increased consumer spending and investment. However, it also created distortions in asset pricing. The effects of stimulus are complex. While it can prolong economic expansions, it can also sow the seeds of future bubbles. As easy money continues to flow, investors may take on excessive risk. The challenge lies in balancing stimulus with sustainable growth. Understanding this impact is essential for navigating future economic conditions. Current trends in the housing market. The housing market is experiencing unique dynamics today. Interest rates have fluctuated significantly. Many homeowners locked in low mortgage rates during earlier periods. This has created a reluctance to sell. Homeowners are hesitant to give up their low rates for higher ones. This trend has led to decreased housing turnover. At the same time, the demand for housing remains strong in certain regions. This has resulted in price increases. However, the market is uneven. Some areas experience growth while others struggle. The interplay between interest rates and housing supply creates a complex landscape. Understanding these trends is vital for potential homebuyers and investors alike. The interplay of interest rates and asset prices. Interest rates play a crucial role in determining asset prices. When rates are low, borrowing becomes cheaper. This encourages spending and investment. As a result, asset prices tend to rise. Investors seek higher returns, pushing more capital into various markets. However, as interest rates increase, the dynamics shift. Higher rates make borrowing more expensive. This can lead to a decrease in consumer spending and investment. Consequently, asset prices may face downward pressure. The relationship between interest rates and asset prices is complex, yet significant. In recent years, we have seen how quickly interest rates can change. The rapid rise in rates has led to volatility in many asset classes. Investors must remain aware of this interplay. Understanding how interest rates affect market valuations is essential for making informed investment decisions. I've researched several investment platforms and recommend Interactive Brokers as a suitable option for beginners. Click the first link in the description to learn more. Monopolies and their influence on market performance. Monopolies have a profound impact on market performance. They dominate their sectors and can dictate pricing. This power can lead to higher profit margins. However, it can also stifle competition and innovation. As monopolies grow, the risks to the broader economy increase. Today's market is increasingly dominated by a few large companies. These giants use economies of scale and extensive reach, leading to concentrated wealth and power. This dominance poses risks for investors. While these companies may offer strong returns, their market control can create instability. A market reliant on a few key players is vulnerable to shocks. Investors must carefully consider these risks when formulating long-term strategies. Understanding market valuation metrics. Market valuation metrics are essential tools for investors. They help assess whether an asset is overvalued or undervalued. Common metrics include price-to-earnings ratios and price-to-book ratios. These indicators provide insights into market trends and investor sentiment. However, relying solely on these metrics can be misleading. In times of euphoria, valuations can become detached from reality. Investors may chase high PE ratios without considering fundamentals. This can lead to poor investment decisions and significant losses. It is vital to use a combination of metrics. Understanding the broader economic context can enhance analysis. Investors should remain vigilant and critical. Only then can they navigate the complexities of market valuations effectively. The psychological factors in market behavior. Psychological factors heavily influence market behavior. Emotions such as fear and greed drive investor decisions. During periods of market optimism, greed takes over. Investors become overly confident, often ignoring risks. Conversely, during downturns, fear can lead to panic selling. Recognizing these psychological patterns is essential. They can create feedback loops that amplify market movements. Understanding investor sentiment can provide valuable insights. This awareness can help investors make more rational decisions. Furthermore, the role of media cannot be underestimated. News cycles can fuel market emotions. Positive coverage can spark enthusiasm, while negative news can trigger sell-offs. Investors must remain aware of these influences to avoid being swept up in the market's emotional tides. The future of investment strategies. The future of investment strategies will likely be shaped by several factors. As markets evolve, so too must the approaches investors take. A focus on sustainability and ethical investing is becoming increasingly important. Investors are looking for ways to align their portfolios with their values. Moreover, technology will continue to play a significant role. The rise of artificial intelligence and data analytics is transforming investment practices. Investors now have access to vast amounts of information. This can enhance decision-making but also complicate the landscape. Adapting to these changes will require flexibility. Investors must be willing to reassess their strategies regularly. Staying informed about market trends and technological advancements will be crucial. The ability to pivot will define successful investment approaches in the coming years. Navigating the risks of financial bubbles. Navigating the risks of financial bubbles requires diligence and awareness. Understanding the cyclical nature of markets can help investors prepare. Historical lessons offer valuable insights into potential pitfalls. By learning from the past, investors can better manage their portfolios. Moreover, remaining informed about market dynamics is essential. The interplay of interest rates, monopolies, and psychological factors all contribute to market behavior. Investors must stay vigilant and adaptable. Ultimately, a proactive approach is necessary. Anticipating changes and adjusting strategies accordingly can mitigate risks. By doing so, investors can navigate the complexities of financial bubbles and seek long-term. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link